Welcome to Bunnex Investment Group. Today we will talk about the technique we use in deciding the high probability market direction. This means deciding whether the market will go up or will go down. And from backtesting, we hit a very high win rate of up to 80%, and of course working on probability and over a series of trades. But before we go through, make sure you subscribe to this channel and check the notification bell icon if you haven't done so. So we are going to explain this in three parts. The first being levels definition, defining what levels are, as these will actually help us to determine which direction the market will go. Then combination of levels, which is the second part. And last but not least, which are chart examples to show the actual way of counting the levels, how to actually get the bias of the market, and from there actually apply it in real markets. So make sure you stick up to the end so that you fully comprehend this methodology. It's actually something that is very useful, and over the years it has proven itself. So the first topic is levels definition, and as we all know that the forex market attracts retail traders and market makers. By that we are saying it's an environment where retail traders comes and market makers also comes. Market makers are those huge companies with access to large amounts of capital. So we include banks, hedge funds, some brokers are market makers, and by that we are saying these guys are involved. They are involved in what we can say making the market. Why? Because when they buy or sell, the market responds with huge market flow impulses. So for instance, if they come into the market and buy euro against dollar with 13,000 lots or 50,000 lots, definitely it's going to alter the demand of euro. In that case, it's going to raise the demand for the euro, and in that case, we will see the markets actually going up in one particular direction. So would see the external authorities come into play. These are now, if I can say, they are headmasters or the principals or the chancellors that governs how the markets are actually moved. Otherwise, the market will collapse or will actually devalue one currency. So these chancellors are there to actually say, no, today it's enough. That's enough to raise the market with such magnitude, and that's where the levels will actually come into play. So levels are actually a real thing. I've seen several comments that says that levels do not exist, but these impulses are what we call market levels. So market maker levels helps us decide whether the market will rise or drop and with what magnitude. So imagine if you can actually have an idea of where the market is going to move next in a longer time frame, in a shorter time frame, and with what magnitude. How much does that bring change in your trading? Absolutely, very much. So levels in market flow, by this we are saying they are what we call market cycles. In one market cycle we have three levels, and after three levels we will always reverse, right? And in doing so, would say level 1, level 2, level 3 of any time frame of observation can be broken down to three levels of its preceding time frame. By this we are saying if this is H4 time frame, and if we go to H1 time frame, we will expect to see this first H4 level having three H1 levels like this. H4 level 2, 3 H1 levels, H4 level 3, 3 H1 levels like that. So H4, any time frame of observation can be broken down into three levels of its preceding time frame. If this was daily, D1, this was going to be H4, like this. So this principle will actually help us, is now there to help us know how much magnitude are we left out to complete this particular cycle. So this principle is what you need to write down in your notes. It says in whatever time frame of observation, there consist 3 levels of the preceding time frame. In one H4, there is 3 H1. In one H1, there should be 3 M15. In one M15, there should be 3 M5. In one M5, there should be 3 M1 levels, like that. So it helps us to actually pinpoint the most accurate point of entry, as well as give us an idea of how much the market will move in a particular direction and with what magnitude. So let's go over the charts to learn about this technique practically. So this is pound against dollar, which I'm going to use as my example, and I'm going to use rectangles to mark levels on this chart. So the first thing is this is the weekly time frame, right? I'm on the weekly time frame, and on that weekly time frame, to illustrate that on every 3 levels we expect to see a reversal, right? And it works on all time frames. In this case, we are seeing that we had level 1, level 1, level 2, and then lastly level 3, which actually dropped from this point down to this zone. After 3 levels, we expect a reversal, which was issued, and in this case, we are still anticipating a reset. Why a reset? Because the monthly time frame, which is the higher time frame than the weekly, we can see there was 3 levels on this part. We made a reset, 3 levels. We are making another reset. So this level, which is first touch, second touch, is actually a reset that is happening in front of us. So there is a higher probability that pound against dollar is dropping with higher probability. So before we go down to the lower time frames, we now can see the levels that has been issued on this weekly time frame. We have level 1 like that, and from that level 1 we have level 2, which actually went from this point down to this zone. And what are we now expecting? We are expecting to see level 3 of that magnitude, so that we can complete this cycle that is currently in play. So what can we say about the bias on GBP USD? We can say that there is higher probability that this market is going to drop. So going on the daily time frame, right, to satisfy the very same principle that we have said earlier on, we've said in one higher time frame level, or in one time frame of observation, we expect to see 3 levels of drop. So in this case, we have level 1, right? From that level 1, we had level 2, and we had level 3, like that. After 3 levels of drop, we expect to see a market reversal. So 1, 2, 3, and the market reversed. Then we had 1, 2, and 3, like that, right? Meaning that this weekly level and this one were all complete, right? So to verify for interest's sake, can we say these levels are actually complete? Let's now go on the smaller time frame. On the smaller time frame, we can now start to count the levels on the H4, so that we verify if this level is now complete, right? We had 1 which actually shot very fast to the downside, then 2. Mind you, this is only for verification's sake, and I won't be going to the H1 time frame. It's actually verification on the H4 time frame. So we had 3 levels of the H4 time frame. After a 3 levels, we expect a reversal, and this reversal was actually issued. From that reversal, we can see we now have what we call a reset, right? A reset which is now in play. So on this reset, we now start to look for points of entry for the downside, right? Why? We now know that from the higher time frame going down to the lower time frames, we have the downward bias, as you've seen, and now entering the smaller time frame with that downward bias will be high probability play, because the market is likely to move in that particular direction. So basically, that is how we determine the direction of the market. And in this case, we've just talked about the bias determination, but we haven't talked about the entries, which is the most important thing in our trading. We now need to learn on how to find entry points, as well as the setup to stock. Otherwise, it will be disorder in your trading system. So to do so, we have a one-on-one. You can actually book us for a one-on-one call that is going for $500, or actually purchase a pre-recorded advanced course that is going for $99. That is for those who actually wish to take further in this particular trading methodology. On that note, we come to the end of this video. Thank you for watching. Like and subscribe. See you on the next one.